You place the trade, the entry is clean, the setup was there, everything lined up, and then price starts moving in your direction. And that's when it gets difficult, because now there's real money on the line. And suddenly your brain starts doing things your strategy never planned for. You want to take profit early, you want to move your stop, you start watching every candle, every little pullback feels bigger than it is. So in this video, I'm going to walk you through exactly how I manage a trade from the moment I enter to the moment I exit. The rules I follow, the process I use, and what's actually happening in your head while all of this is playing out. When I enter a trade, there are only three things I need to know: my entry, my stop, and my target. Everything is decided before I'm in the trade, not while I'm sitting there watching candles move around. So where does my stop go? Well, that's pretty simple. It goes at the swing high or the swing low the trade is built on. If you look at this example, we have a bullish entry confirmed by an order block. The swing low is the low formed by these down close candles right before the move higher. So this low is my stop. Because if price breaks below that level, the setup isn't valid anymore. So the reason I took the trade no longer exists. And the target works the same way. Before I enter, I already know where I expect price to go. That could be in external range liquidity, a fair value gap, a premium zone, wherever the higher time frame is pointing towards. The important part is that it's decided before I enter the trade. I'm not moving targets around because price is moving slowly or because I'm feeling nervous. Once I have my entry and the trade is running, this is where the management starts. The first thing I'm looking for is a short-term target. As soon as price reaches one, I move my stop to break even. So let's see here, price reaches the short-term target, so I can move my stop to break even. Now the trade is protected. At the point, the worst-case scenario is I walk away flat. Then if price reaches 2R, twice my initial risk, I take most of the position off. So right here, I take 80% of the position off, or 90%. Here's where I secure majority of the profit. And I leave a small runner open in case price keeps going. And from there, I start trailing my stop behind the move. For example, here, a new swing low forms, confirmed by this OB. I move the stop up right here, trying to lock in more profit as price continues higher. So let's see. Right here, we have a new low forming, and that's where I move my stop. Again, here we have a new low, so my stop would be here, but then we also reach the final target. And that's the whole process: entry, stop, target. Move to break even at the first short-term target, take most of the position off at 2R, and let the runner do its thing. Everything is planned before the trade opens. Nothing is being decided emotionally in the middle of the trade. Now, this is where trading actually gets difficult. Before you're in a trade, everything feels easy. You've done the analysis, you like the setup, you know where your stop is, you know where your target is, and everything makes sense. And then the trade goes live. Now there's money on the line, and suddenly you start making decisions that weren't part of the plan. And I've made every one of these mistakes myself. The first one is moving to break even too early. This is probably the most common one. Price moves a little in your favor and immediately you want to protect it. So you move your stop to break even. Not because your plan says to, but because you're scared of giving the profit back. And then price pulls back normally, takes you out, and goes exactly where you thought it would. The setup was fine, the analysis was fine, you just got nervous. For me, there's only one reason to move to break even. Price has to reach a short-term target first. That's the rule. Not because I'm uncomfortable, not because I'm watching green candles, because the condition was meh. If it hasn't reached that level, the stop stays where it is. The second one is closing too early. So price is moving towards your target, you're in profit, everything is working, and then you start thinking, maybe I should take it now. So instead of taking 2R, you close at 1.5R or 1.6R or whatever is available at the time. And that feels like discipline, but it's not. It's fear dressed up as discipline. You took the full risk when you entered the trade, but now you're taking less reward because you're uncomfortable while the trade is open. If the target was valid before you entered, it should still be valid while you are in the trade. The third thing is moving the stop to give it more room. And this is the opposite problem. Price starts moving against you. It's getting close to your stop, and suddenly you're looking for reasons to move it. Maybe the market just needs a little more room to breathe. Maybe it's going to bounce. Maybe you are still right. But that's not risk management. That's ego. You just can't accept being wrong. You place that stop there for a reason. If price breaks that level, the setup is invalid. And that logic doesn't change just because you're in the trade now and it hurts to watch. When you move the stop, you are not saving the trade. You are turning a planned loss into a bigger one because you don't want to accept being wrong. Let the stop do its job. That's what it's there for. The real issue underneath all of this is simple. Fear makes you close too early. Ego makes you move your stop. And both of them are doing the same thing, overriding your strategy with how you feel in that moment. And the truth is, those emotions are not going to disappear. Fear doesn't disappear. The ego doesn't disappear. Every trader feels them, no matter how experienced they are. The difference is that over time, you build trust, not from watching videos, not from reading about psychology, but from collecting evidence. When you have a strategy that you have actually tested, that you have journaled, that you have seen work again and again, you stop feeling the urge to interfere with it because you have the data. You have seen what happens when you follow the rules, and you have also seen what happens when you don't. And at that point, touching the trade midway, moving the stop, or closing too early, second-guessing the target, it doesn't feel like protecting yourself anymore. Any rational person who has that evidence in front of them would leave the trade alone. And that's the goal, not to feel nothing, but to have enough trust in what you've built that the emotions lose their power over your decisions. That's the whole game. Not the analysis, not the entry, not even the exit. It's having a process clear enough and trusting it enough that there's no room for emotions. The traders who become consistent aren't the ones who feel nothing. They're the ones who trust their process enough to follow it, even when it's uncomfortable. So to recap, stop below the swing low, target set before entry, move to break even once the first short-term target is reached, take most of the position off at 2R, and let the runner do its thing while you trail your stop behind it. That's the process. But the real challenge isn't knowing the process, it's following it. When you're tempted to close early, you don't. When you're tempted to move your stop, you don't. You trust the plan you made before the trade was live, before the emotions showed up, before the money started moving. That's what consistency actually looks like. Executing the same way over and over again. If you haven't seen the entry rules video or the risk management video yet, they're linked below, because trade management only works when the entry and the sizing are already right. If this video helped you, like it and subscribe. Follow me on my Instagram at Sierra Trades. I post there every day, and this is where I share a lot of the day-to-day trading content. I'll see you in the next one.